Hello, everyone. So today I'm thrilled to welcome Tom Engel. Tom has he's one of those person who had the most profound impact on my investing journey. His writing and analysis helped me avoid all kind of errors which any beginner would make in his investing journey. Tom himself started investing very early in his teens and became financially independent in early 40s. He's not only a great investor, but he's also a great teacher. Now, at 70 years young, he brings wealth of wisdom and experience, whether it is his knack of spotting opportunities. I remember Tom once found out a company selling for less than the cash it has on his balance sheet, or his ability to stay steady in turbulent times. Tom's perspective is something which you wouldn't want to miss. I have followed Tom for like last 20 years, I believe. And first time I spoke to him was like a few weeks ago. And when I requested him to join this podcast, he graciously agreed. So, Tom, thank you for being here. Let's get it started.
Okay, great. I appreciate you having me.
Thank you so much, Tom. So, Tom, I guess, we're going to start. You started yourself investing very early, right? What
Yes.
triggered you to start investing that early in those days?
Well, my grandfather started investing and he did it really well. He became, I would say he was financially independent, or at least he was able to retire early. And then dad kind of took his lead, started investing. He did very well, but he quit after he got enough money to start his own business. He wanted to become a businessman. He wasn't really that interested in stocks, but him and mom always said that I needed to continue to study stocks, keep investing. If I put money in it, don't take it out. That didn't mean I couldn't sell stocks. It just said, in that brokerage account, don't take it out. Always keep it there for the long term. And I think that I think I took my mom's lead on that and really just started studying and observing. And if I didn't want to buy it, at least I wanted to be able to learn about every stock that I could, study without wasting too much time. There's a lot of stocks you probably don't need to study, but the more popular ones, I observed them over the years, and I got to where I really could kind of get the idea of how they're going to react in a recession and how they were going to recover and what stocks didn't recover. So those are things I learned, and it made investing a lot more fun. I was more confident in it. When the 74, 75 recession hit, I was just like everyone else. I panicked. I thought, I don't even know if I want to do this anymore. But it recovered. And that was my first lesson, not to be afraid of recession, just keep investing. A little bit. Don't invest a lot, just keep investing little amounts. That's all. It's all necessary.
Wonderful. And so at what age did you buy your first stock, Tom?
I'm sorry, what?
At what age did you buy your first stock?
Oh, I bought my first stock when I was 12. So
wow.
Yeah, so I started early, but I also panicked during the 74 and 75 recession. But I started then, and I think that's what started the journey. And it didn't take me too long because I did follow my mom's advice. If I put it in a brokerage account, I did not take it out. And I kept figuring out ways to invest it and learn from my mistakes, try to emulate successes. That was the most important thing I think that I've learned is just try to duplicate the things that work. What caused that stock to go up? Usually it boils down to how much cash flow they were making, how much net income they were making, things like that. They had to have good fundamentals. And if you stray from that too much, it's not that it can't work out. Matter of fact, it can work out very well. But for every time you have a big success doing that, you're likely to have a big failure too. So you got to watch that. When you're young, you really need to invest safely as you can. You want your returns and you want to learn, but you definitely don't want to just throw money at anything that's hot right at the moment. That a lot of times that does not work. Sometimes it does, but a lot of times it don't.
Great. And Tom, and I was just thinking, I know two other people who started investing at the age of 12. One is Mr. Warren Buffett, and second is David Kratzman, Pencils 2 guy.
Yes, David. Of course, Warren Buffett, I'm in nowhere near his league. So no use making that comparison. David Kretzmann was very, very smart at age of 12, much smarter than I was at age of 12. He was at a point at 12 years old that I was much, much later in life. He was able to not panic when bad things happen to the market. So yeah, he was an amazing person. Still is.
So Tom, let's start about stocks now. My first question is, how do you screen stocks? How do you, find the stocks to invest? And what criteria do you use to decide that this one I should be investing and this one I should not be?
Okay. Well, I don't use screens, although screens are wonderful to use. What I do, I let the Motley Fool screen my stocks. Seeking Alpha screen my stocks. In other words, the Motley Fool has tons of free articles. So I read a lot of those. If it's a company I've heard of, I read it. If they repeat articles on it regular, I figure they're pretty popular. Go to Seeking Alpha, you get the same thing. And I read those. I think reading is very important. You want to read as much as you can. People have lives, and so they can't be doing this all the time. So I try to stick with, like, say, a couple articles a day at least of stocks that I've heard of. And I enjoy doing that. Plus, that's how I get my list of stocks. This guy thinks it's really great. This guy might think it's really bad. I take the pros and cons of each. But before I invest in it, I make sure of one thing. They have to have cash flow, and they have to have strong GAAP earnings. I'm okay with vesting some that don't fit that criteria. But if I do, I use very small amounts and do it very slowly over time. So the majority of my money will always go into good, strong cash flow producing companies that have GAAP earnings are very close to cash flow. In other words, if cash flow per share is 50 cents, GAAP earnings is 50 cents, that's nice. If it varies 10 or 15 cents, no big deal. But if it's got, a company has cash flow of $1 per share and GAAP earnings of 1 penny, something's wrong. And normally it's stock-based compensation. I don't like to do too many companies like that. So sometimes a company could be selling real estate and have a profit. That's a one-time event. That's okay. Make that adjustment. That's okay. And so GAAP earnings can be that big of gap between cash flow and earnings if there's a one-time event. Stock-based compensation is not a one-time event. It's not only every quarter you're going to get stock-based compensation. It's going to increase. The amount of it usually increase with sales, not earnings, sales. And that's not a good thing. It dilutes your hold on the company. And the bad part about it, if they continue to do that and they don't become profitable, then the companies tend to disappear. And tech bubble was, in 2000 was a good example when a lot of those companies just disappeared. Few made it big, but not all of them. And most of them didn't make it. Oh, so go back to the question, cash flow, GAAP earnings. I want them to be strong. For the majority of my money, I want to make sure. Now, I use price to earnings. I also use a cash flow yield. I don't use price to cash flow, although I could. It's just that cash flow yield seems to tell me more, tell me what they can pay in a dividend pretty much. A percentage of that they can pay as a dividend. So I like that, comparing that with P ratios. I do try to make adjustments when necessary with the P ratio to make sure that, I'm not including something that inflates it or deflates it unnecessarily. So I want the valuations to be good, but great companies aren't going to be trading at great valuations, especially not in bull markets. So I want to buy just a little bit and try to buy at better value points over time. So I try to keep a lifelong perspective. The building process is, you tell your mind, especially when you're young, this is a long road to travel. Your journey's going to be a long one. Make it that way. Don't try to get rich quick. That's usually how most people fail. They end up making way too many risky investments and losing their money. So, it's really I think it's much better to be safe. If the valuation is high, buy a little bit and hope for a better valuation later. Price could come down. That means the PE ratio comes down. The value is better. Cash flow yield goes up. The value is better. But let's say we're in a bull market and it just keeps going up. And you're saying, well, yeah, I could have bought this as a PE 30. Now it's PE 40, PE 50. I get that. That's horrible. I mean, it's a horrible way to think. You got a little bit of money. You want to put more in it. Like I said, you can always do that a little bit at a time if you want. But understand, if earnings go up faster than the price, then it becomes a better value. Even if the price is going up.
Right.
That is an opportunity you usually get every year. And that's what a lot of people don't see. These little dips after an earnings report, a lot of times will bring the price earnings ratio down close to where you bought it last time or even below it. So that happens a lot. So you can always buy better valuations if you're patient, especially when you do that over a number of, really good stocks.
So two things I kind of, you mentioned. One is to build your position gradually over time. And then second thing is that buy at better valuation.
Yes.
Right? Even if the price has gone higher, it could be at a better valuation, especially if, any of the metrics you're using, P ratio or cash flow yield or anything else, if that is low and the price is high, the company is at a better valuation.
Exactly. And if you really have confidence in a stock, there's really no bad time to buy it. In other words, say the valuation got worse, but it's not ridiculously worse. Go ahead and add to it. That's okay. I know some stocks I've added at worse valuation and been fine, but they had good, strong cash flow, good earnings, so I wasn't really worried about it. And if we're not going into a recession, which, you can get a lot of clues about when the market's going to really fall. It don't have to be a recession. It could fall from an overvaluation. If the market as a whole is overvalued, it can fall. And a good signal for that, when people stop going with price to earnings ratios and cash flow yields or cash flow multiples, and they start switching to price to sales. Then we're getting toward the top. They're trying to find an excuse to buy these companies. That's why they're on television and writing books. They got to have something to buy, and if everything's overvalued, what do you tell people? And so they say, well, the price sales ratio, that's relatively good. They use relatively good. Yes, it's 50. It's a price sales ratio of 50, but there's a lot of stocks price sales 60 and 70, so relatively good. It's not good. That's not good. And when it goes to a price to price to sales ratio of 100, that's when I know it's time to start selling stocks, especially if they're not got good, good fundamentals. If they got good cash flow and earnings, you can lighten. But if it's one of these stocks that I bought because it's momentum, fundamentals weren't that great, but everybody loved it, that's when you sell those. You make sure you get rid of them. You want to keep a little bit of it, fine, but you should have made plenty of money on them. When they start saying price sales ratios of 100, now it's time to get out a lot of them. And I don't mean the ones you're selling may not have price sales ratio, but if the most hype ones, a couple of them do, it only takes one or two. If it does, it's time to sell. That signal's always worked out for me. Now, I don't know if it will in the future, but I know one thing. If we're in the market, I'm fully invested. And when I say fully, I'm always going to have my 10 or 20% cash cushion. But if I'm fully invested, people start talking about price sales ratios 100, I know it's time to start lightening those more hype stocks.
Very good, Tom. So, Tom, you said that you look at companies which are fundamentally good, right? What parameters makes it fundamentally good? What are the things which kind of tells you that it's a fundamentally good company?
Well, I like for them to have a long history. I mean, you can have strong GAAP earnings and strong cash flow, but I think the longer the history of them being able to do that, generate good, strong cash flow and earnings, I think that's one really good thing that's very useful. Besides that, I'm going to tell you that there isn't nothing I worry about. Oh, balance sheet. I do like them to have more cash and debt. I like to be able to pay their debt off in 5 years if they could through cash flow. Not that they will, because there's penalty for early, repayment of debt. So they won't, but at least want to know that, they have enough cash flow being produced that they could eliminate debt completely in 5 years or less. I prefer less, 3.5, 4 years, that's good. So other than that, I don't mind. I like to see growth. I think that's important. I like to see earnings growth and growth in cash flow. I don't need it to be every year. I mean, every company has a bad year from time to time. But as long as their cash flow is strong per share, earnings strong per share, then there is a bottom, there's support if the market goes down. With other stocks that don't have those things, and then, they have no support and they can go down for a very long. And the SaaS companies, services as SaaS stocks, it's so hard. If you bought them at the peak, that was really terrible for investors. And they didn't have good earnings. They didn't have some of them would have cash flow, but it certainly wasn't enough to support the stock price. Well, I have a pretty good way to determine that, even with these hype companies. If cash flow is $1 per share, and if cash flow $1 a share and the earnings is like 20 cents a share, well, just add them together, divide by 2, use that 60 cents as a P, like a P ratio. That'll give you a little bit better understanding of the value of even these overhyped stocks. With that said, almost every single time they'll be trading at, we'll call it true price to true value of 100. And that's high. It'd be like a P, right? A true P of 100. But if it is, 20 or 30, that's not so bad. And you can maybe hold on to them stocks a little bit longer.
Okay. Very good, Tom. What a great answer. So, Tom, we touched base about a couple of things, which I'll come back again, like a cash cushion and position sizing. Let me ask you this: when you start looking at a company, right? Let's say you found something in Motley Fool which kind of excites you, and you want to learn about it. How much time do you spend in analyzing it before you buy your first position?
Okay, well, that's a good question. I can buy a company pretty quickly and go over it pretty fast. It takes me about 3 hours to go to the SEC filings, find out when they, like for instance, you take a company and you look for the quarterly reports. You put the date of that quarterly report on a piece of paper. And then you find the next quarter, put that date on a piece of paper. And then you want the trading range, the price range between those two quarters. Between those two quarters. You want the P ratio of those two quarters. You want the cash flow yield of those two quarters. And I use price sales ratio of those two quarters. But that would, if you want to save time, leave the price sales ratios out. They're really not that important. So I can do that in about 3 hours and have about 5 years of history. And that's enough to tell me whether or not the cash flow and earnings will support the stock price, and if the earnings are pretty consistent and they're growing at a reasonable rate. So I can find out about that. Say they're not growing at a reasonable rate. I can also check, I want to check market cap. I might want to check how mature they are, how many years have they been producing cash flow. You usually go to Morningstar, and I don't know if you can go to Morningstar and look that much history up, or just go to SEC filings 10 years back, 20 years back. The SEC filings make that a little difficult sometimes, but if you put the date in, like 2008, they still have those records, and they'll pull them out for you. So I didn't know that until recently, actually. So, oh, wow, because they changed the format. I thought, oh, they took away a lot of the, the SEC filings. But they really haven't. If you put the dates in, they give you a place where you can. Say you want quarterly reports, they'll go back to those year dates. Put about 5 years, like between 2008 and 2010, for instance, and they'll list those. I probably wouldn't do more than a few years because it takes too long for them loaded up. If you do 2 years, it actually works out pretty well. You don't have to go back that far normally, but usually 5 years. But you do want to go back to the 10Ks, back as far as you could. I said 2008, but actually you get them all the way to 1990s. That's what I should have said. Time passes funny when you're old. So 2000 in the 1990s, you could go back and get those. You could find out were they making good money then. You only have to look at the 10Ks. You can go to like 1999, 2004, just get some idea. And that'll give you a pretty good idea of what their history. You can do just a Yahoo chart map, maximum, chart. Go back early and just see how the price is done, which is a pretty good indication if it's been up for the last 20, 25 years, and probably earnings and cash flow have been pretty good too. So you can do that. So I like to have a history, but I'm not too overly worried about it. If I've got 5, 6, 7 years of history and they've done that well, chances are they're pretty good. I like a brand name, but with brand names, that's a Peter Lynch thing. Know what you invest in, what you know. It's nice, but everybody knows what Coca-Cola is. Everybody knows what Pepsi is. Everybody knows what Hershey is. And the price to earnings ratios are very high usually for these stocks, even though they're not growing that much. So they're very mature. They're not that they're bad places to put money. They actually can be, because the one thing, sure, if they do dip, if you put money in them, it may stay there a long time, but when it goes up, you're at least confident you're not going to lose a lot. And I think that's important to say. Make sure you don't make any real big mistakes. You want to preserve money if you can. Growth will come. But if your stocks aren't doing really well, you're not beating the S&P 500, then you need to find younger companies that are also growing, still need fundamentals. I find there's plenty of them. So I've never had a problem finding the best companies, using the Motley Fool as a good screening tool, using Seeking Alpha, same way. Make my watch list of stocks, find the ones that got the best fundamentals, find the ones that are trading at reasonable valuations. They, just on they're not really high. If they are and you still like the stock, you think, well, this company to me has such a great future. Of course, they all do when they're being hyped. Everybody says they got a great future. But if you really believe that, then buy a little bit of it. If valuation isn't that good, because you're going to get a chance probably to add to it at better value points. And so I use the Motley Fool and Seeking Alpha to screen the stocks, the fundamentals. That's just about it. I do look for good management. I keep the CEO of all my companies at the top of my note page when they change, but I don't count on it being too much, because I think if a business is bad, the best CEO on the planet ain't going to help them. Not going to help them. But if if it's good business, I don't know who said that, but I think it was Peter Lynch, might have been Warren Buffett.
Warren Buffett, yeah.
Any idiot can run it. When they're a good business, any idiot can run it. But so I don't really look at the CEO. I love to have a good CEO, one that's confident. Middleby's actually a good example, and I can't even remember his name. He's been gone so long. But he ran that company. He was so charismatic. You just believed everything he said, and he did a fine job with them. And then he left. Middleby didn't go bust. The next guy come in, he done all right too. It's a mature company. I mean, how many little utensil makers for restaurants can you buy and continue to have, growth? So I think I look at the CEO and I want to believe in him. But if things go bad, and I'm really not going to put the blame on him, it's just maybe the business wasn't that great. If it has a long history of doing well, any CEO is going to be able to do a good job on it, most likely. So I don't worry about it. But if it's a new company, like I say the best example, one that I'm scared to invest in, but I have anyway, was Salesforce.com. The CEO is very charismatic.
Yes.
And when you listen to him, you almost say, it has to be right. He just believes it so much. So I think, I buy a little bit of that one. And of course, it's done well. I do more trading of that one than I do because cash flow isn't that high. Earnings isn't that high. It's getting better now, though. Actually, those metrics are getting much, much better. So I'm kind of impressed with that. I still do more trading with Salesforce.com because they're a big company and they have very high stock-based compensation. So I'm just wondering, can they ever bring the valuation to a point where it would be safe to invest and me getting a good return? Safe, maybe, but I get a good return 10 years down the line. So I'm always keeping that on my list. I do a lot of trading with that, keep a small amount as a core position just in case they do, do everything they believe they're going to do and, I don't know, dominate the world. Then surely, but a little bit will be plenty. And I won't be risking that much. But I do depend on my core portfolio to give me my growth, provide my safety, and then I work around the edges in order to boost growth.
So, Tom, I got two questions, I guess, on that. First thing, how many stocks do you have in the watch list, and how many stocks do you follow? That is my first question. And second question is, I'll come back about your trading thing. How do you manage trading while having a core position in a stock, basically? Is it like a momentum-based trading based on a technical charts, or do you have fundamental valuation metrics and you use that to trade around your core position?
Can you repeat the first part of the question first? Because they seem to be a little bit different.
No, not about. Yeah, first part was, how many companies do you have on your watch list, and how many companies do you follow?
Let's work with that. Okay, let's work with that first. Here's the thing I don't think people can duplicate easily. I like to invest, so I love studying the market. I do it every day. I would do it. I can't even think of what I would spend my time on. I love to garden, but for the most part, looking at the Motley Fool, reading the articles, that stock sounds pretty good, write it down, stuff like that. I love that. Going to digging in SEC filings, transcripts, conference call transcripts. I like reading that. I love reading it, learning about these stocks, looking at what CNBC says, what they are hyping, whether I believe it or not, checking out what I think, what they think, grading my score against them on paper. I like doing that. That takes a lot of time. Most people can't do that. I own 77 stocks, but I can study 77 stocks easily, and still have time left over to study more on the watch list. But I'll never be an expert on any one of those stocks, except maybe after 10 or 12 years. Then, yes, then I'm pretty good with those stocks. I've owned most of those stocks for, at least 10 years, and some for 15, some for longer. So I'm pretty good with the stocks I own. So I can add a one every once in a while. Most people are not going to be able to do that because it's still going to take a lot of time. So I think a person should probably stick with a few stocks, maybe 25, and be diversified over maybe 25 stocks. I think that's pretty good. And I think most people could study that and using, conference calls, transcripts to kind of see if there's anything. No, you use AI. That's what you should do. That's what I do now. It's making my time so much easier. Why read a transcript when you can go to an AI? I use Gemini 2.0, maybe 2.5 now. I don't know what it is now, but I can tell them to summarize an earnings report, and it can do it right there in front of me, just like that. And I check every point. I always do kind of check and make sure that they're accurate. I'm confident enough that they're going to be accurate enough on the main points. I write them down, copy and paste, copy and paste. That's all I do. It takes me a few minutes. That's all I have to do on that. But if it's something I think, well, this is a new product, I said, maybe I do want to dig a little deeper on that. Then I do that and I put my notes down. Now, a lot of people, even that way, might not be able to study enough stocks to be useful. But if you can study 25, great, that's plenty. But say you can only study 5. That's all the time you got in the whole wide world. Well, you're going to be under-diversified, most likely. But you can learn about those 5 stocks till, if you're buying little at a time. They got good fundamentals. That's okay. In fact, I think the best diversification you can have, ideally, would be one stock and the rest in cash. Can't lose on that. You don't want to do good on that. Unless your stock is really bad, then you would. But you won't lose much because you got all this cash. But if it goes down, you can add a little bit more to it. And that one stock, get comfortable with that one stock. Say you buy a little bit and it goes up, and the valuation gets worse and worse, and you can't add to it. Well, find another stock. And if that stock has got good fundamentals to it, good cash flow, good earnings, you don't have to study it that deeply. I've got stocks that really you don't have to worry about. I don't have to worry about Starbucks. Yes, they got problems in China growth. China and the United States don't like each other anymore. So who knows what's going to happen there? And you don't know. But they make a lot of cash flow, and they make a lot of cash flow and earnings just from their profits in the United States. They also make a lot of profits from China. So that's going to be maybe a problem. Need to look at that. But other than that, Starbucks pretty much takes care of itself. When it dips, I buy some. It goes up, I sell some. When I do that, I do it in an IRA. It's tax deferred. I'm not going to do that in a taxable account. It would be you just be spinning tires. You can't really, it's hard to make money if you're trading. And I really don't, advocate that. But if you do, trade a little bit in an IRA. If you want to do a taxable account, make sure you hold your stocks long enough to get a lower tax rate, which I think 15%. United States, I know it is. It's 1 year. You get 15%. I don't know what it is in other countries, but I would check the tax laws. If you're going to trade in a taxable account and you're going to pay a lot of taxes, you're just going to be spinning tires. You're not really going to make any money. Then you've got to be very careful that the fundamentals are good. Or if you have a loser and a winner at the end of the year in a taxable account, you can sell equal amounts of the winner and loser, no taxes. So that's good. So you can do that and then improve your portfolio, fix it over time. So I'd say for most people, just start out with one stock, study it. If you think you got 2 or 3 that you're pretty comfortable with, add them, still do a little bit at a time, buy better value points. Build your portfolio over time. And don't worry too much about making mistakes. If you're a beginning investor, you're going to make mistakes. I made plenty of them. But from every mistake, you learn something. When you have a success, you learn something. When you have success, figure out what caused that success. Was it the brand? Was it growth? Was it a good valuation? Did they have strong cash flow, strong earnings? Great, then you want to repeat that. If it was a super hype company that just went up and up and up, well, find out what they did. See if every hype company at the same time, there's so many of them in the market at any given time, when one's doing good and a lot of them are doing good. Are they all going up? In which case, pretty sure that could be more of a hype thing, not in a market in a time when the market is really good. So you might want to watch that. I still think you should stick with fundamentals, especially starting early. When you're young, and everybody says you should take risks when you're young. I don't believe that. A young person loses money in the stock market. That's what he's going to remember all his life. He's never going to want to invest anymore. And if he does, it's 20 or 30 years down the line. He said, okay, well, the market's doing great. CNBC, everybody's going, yay, market's up. I made so much money. Oh, my neighbors made so much money. I'm going to get back in. Usually that's when the peak of the market is, because that's when everybody's hyping the market, and they lose money again. So if you're young, stick with strong fundamentals, build your portfolio, slowly over time. And then you want to take risk. When you're rich, you can afford to take risk, then take risk. Then buy all the companies that are being hyped and get in there and get back out. Do whatever you want to do then. But until you build up a pretty good portfolio that you're happy with, I wouldn't take very many risks. I wouldn't take any. I was pretty careful all my life, and I was good with that.
Tom, that's very, very interesting. And one very interesting thing you said was it takes like 10 years for you to become an expert on any particular stock. People shouldn't rush or even try to become a master on any company. It just takes time, I guess, right? That is the whole idea, right? And second thing is that, do not jump on putting all of your money, at one point in time. Try to invest gradually and over time.
Right.
Right. So, Tom, when you said that you want you kind of trade in and trade out in any position, you are not talking about trading based on the technicals of a stock. You are talking about trading based on the fundamentals, and that trading happens over many quarters, not like on days, over any number of days or something like that, right?
Okay, definitely let me explain that. Um, I keep a core portfolio, a core position in every one of my stocks, unless it's a new stock, then it's something I have to build up over time. But on the companies that I know the best, I will trade them in IRA. I do not trade full positions. I trade small amounts when the stock, and I base that on fundamentals. If I notice a range, this company is reasonably mature, and it's trading within a range over the last several quarters. I thought, well, every time it gets to this point, it comes right back down. Its P ratio is this. Maybe that's a little high for this type of company, this maturity, at this level of maturity. So then, yeah, I'll lighten it. And if it goes down, I'll rebuy it. If it doesn't go back down, it goes into my cash cushion. Then one of my other stocks, if that price is down. When I say price, I'm mainly thinking about the P ratio being lower or the cash flow yield being higher. If cash flow yield, which I'd rather use cash flow yield actually. And the reason being is that tells me a better sense of valuation. It tells me what a company can pay in dividends if it chooses to do so. It can always pay out 50% of the cash flow yield. So that's pretty nice to know. So if the cash flow yield gets higher, I know at least 50% of that is pretty safe, and we're going into a recession. Chances are we're still safe at this level. So if it goes down and the cash flow yield goes higher, this company, I'll buy some of it. So I do that with all my companies that's within the core positions, not my hype companies. That's a little bit different trading process.
Mhm.
Then I know they're going to be very volatile. The hype companies tend to have very high betas, which is very much fun to trade. When they go down, as long as you're using small positions, they go up, you can trade in. You usually do that a lot. Palantir is a great example. That thing's flopped all over the place. You could have traded that to pieces. I like that. I like doing that with them. That way, I bring out enough cash that if I am stuck holding some, it's paid for anyway. It's not the best way to look at it, but it does this. It scratches that trading itch. We all have. We all like doing that. Very few people just hold stock, buy them, and just let them go. I love the way I do it because it keeps me from bothering my core positions. That's going to be my growth forever. So this, and it's fun. It does, long-term portfolio, holding it, adding to it when, better valuations and watching it over decades. That's like painting a house and watching it dry.
Sure.
You're just sitting there. It's so boring. But that's where you make your money. So you have to do that. But if you want to have a little fun on the side, we'll sure trade a little bit. When you're old enough, rich enough to afford it. Don't do this when you're starting out. Start out with solid companies. Build that money up till you're happy with it. When you're happy with it, then you can start. You don't have to be super rich. I'm just saying when your portfolio, you're happy with it, the amount, say you've got a little bit more financial independence, and do a little risky stuff, But definitely don't take a lot of chances when you're young or just starting. Invest as if you were investing for the next 50 years. Say you're 70 years old. If I was starting to invest right now, I would invest as if I had 50 more years to invest. I don't think about be dying quick. I wouldn't need money anyway. Same principles apply. If you invest for the long term, you're usually going to get that payoff with the next, first year to 5 years. You're going to get a good payoff if you bought at better value points. But you got to think, well, a recession could come that could throw that off. So you got to think, 50 years, 20 years, 20 years, whatever, long term. Even if you're 70, you should think that. If you're 90, you should think that. If you're starting to invest at 90, and I've had people when I was with the Motley Fool, I just started investing. I'm 90 years old, and I was thinking, oh, wow, what do you tell someone like that? Can't tell anything different. You have to do the same thing that with any new investor. You got to buy a little at a time, buy good value, buy good stocks at the best valuation you get, and you got to think 5, 10, 15 years. Got to think down the road. You got to have a long-term perspective, even if you're 90. You got to have that mindset. Otherwise, you're going to try to get rich quick. And if I was 90 years old, I wouldn't want to take no risk to get rich quick. And I don't care how desperate I was, I'd find another way. Stick with a good company. Usually you'll get a good payout next couple of years if you bought it at a reasonable valuation. And if you're just starting to invest, that's hard to learn. So it's not an easy question if you're 90 years old. Not an easy question if you're 70 years old. But if you're young, it's easy. The market should be almost foolproof. As long as you stick, you can definitely lose your money investing. Don't care how old you are. But if you stick with strong companies, good cash flow and good earnings, I think losing money over the long term is hard. I mean, I don't know any other way to say it. I mean, Motley Fool hated it when I said it was easy, but I think it is pretty easy. As long as you do that, you got to learn a little bit about valuation, which is very simple. I mean, P ratio, a sixth grader knows how to do the math on that. Cash flow yield, sixth grader knows the math on that. So that part's easy. All you have to do is be patient after that and try to add your small amounts as the value gets better. If you've owned a company for 5 years and you're really confident in it, then valuation don't mean as much. If it's, we're in a bull market and you see it going up, yeah, go ahead, you can put more money in. And how much is, depends on the individual. I know how I do it, but it's, if I like a company and valuation is getting out of hand, but we're in a bull market and I know this market's good for the next couple of years. I sense that it is for various reasons, no bad global news, nothing going on that's horrible. Then you can put a lot more money into it. But most people should just stick with easing into it a little at a time. And I don't like sticking a lot of money ever into anything that's going up and the valuation is getting worse. I don't mind it if the price is going up and the valuation is getting better. But if it's getting worse, if it's a really bad valuation, you got to be pretty careful on that. So I don't like just throwing money into the market, even if I really like the company. There's always an opportunity to buy good companies at a reasonable valuation.
So Tom, you mentioned that, if you have an idea about, whether it's a bull market or bear market, you will let your companies run if it is a bull market. What do you think about how it is right now? Where do you think we are, seeing all the things happening at the global level?
Well, I put it this way. If I was an ostrich, you couldn't see my head right now. The war in Ukraine was bad enough. That's bad. But now you've got what's going on in the Middle East. That adds to that's bad. Then you've got trade wars. That's bad. So I'm very careful. That's why I'm trading more in my IRA than I ever have. Well, I got a higher cash cushion than I ever have. When we were, in Motley Fool, I always kept my cash cushion between 10 and 20%. And at 20%, I never let it go above 20%. And based on not the current price, it's based on a price that I wanted to protect. For instance, let's say your portfolio is worth $100,000 and it's grew to that, and you're really happy with that. Well, that would be a point where I protect it. In other words, I would say this is where maybe I would lighten a little bit, and if it goes down, place that money in my better stocks at a better P ratio. I add a little bit more cash to my cash cushion. And I do that to kind of protect that position. If the price goes down, then I can add to it. And if the P ratio is better and the cash flow yield is better, then chances are I'm going to get that rebound and make a little bit more money. I don't go overboard doing that, but I keep that position. I don't mind if now we got 100,000 and it goes up to 200,000. I didn't lighten none, but I've kept it at 10. I'm fine with that as long as the stock market looking pretty reasonable, the global news isn't horrible. I'm good with that. But got to remember now, your cash cushion is not based on 200,000. It's based on 100,000. So 20% of 100,000, obviously less than 200,000, based on 200,000. So I do it that way. That's how I govern my cash cushion. But right now I have more in cash based on my last protective area than I have. I've never done that before. And I think it's because the things look really bad. And I will never take a whole lot of my core position out of the market. That's got to be there. And you can't time the market. That's impossible. I mean, anything could happen. Russia could withdraw the Ukraine. Iranians and Israelis could shake hands, become friends. Just never know. China could say, hey, you know what? United States is great. We just love you. And Donald Trump would go and hug they love each other and everything be great. That's never going to happen. But it could happen. You never know. But chances are it's not. But you can't really time the market. You can't really say it couldn't happen. I know one thing. This is a dream. I know I'm not going to see it in my lifetime. Just think if every nation cooperated. When they trade, it wasn't thinking my interest, but mutual interest. Really negotiated something that helped them. And, with the United States and Europe at least, we're supposed to be allies and friends and all that stuff. You would want Europe to do well. You would want to make a situation where they do well. You don't want to cut off, you don't want everything in your favor. And the United States needs to think that way. Everybody needs to think that way. If everybody thought that way, it'd be great. China's trying to build their economy, in which they've done a great job, a fantastic job. They still got a lot of people that's living in poverty, and they want to grow. They got 1 billion some people. They could grow that economy much, much higher. They could be the biggest economy on the planet, and they want to do that. So, you've got to think, if you're ideally, we want them to do well. We want them to grow their economy. Someday it's going to dwarf our economy. It just has to happen. And you got to have that mutual respect. But to do that, you've got to have mutual trust, and there can't be any fear. That's never going to happen. We'll always be afraid of anybody has nuclear weapons. That's just the way it is. So I don't think that's ever going to happen in our lifetime, but you never know, maybe it will. So things could be good. Things could turn out better than we expected. So you can't really time the market. You can't really be trying to trade based on that. So what I do is I just trade based on the fundamentals of my own companies. If I see the global news bad, and it's really bad, I've raised my cash cushion. That could be a mistake. It could hurt my long-term growth. I'm not worried about that. What I am worried about, if I'm right, and we go into a really deep recession, a global recession due to those tariffs or whatever, that is what I'm trying to protect myself from. I don't want to see us go into what would be a Great Depression scenario. Now, back in 1929, when there was a Great Depression, part of what caused it was tariffs. It wasn't just the tariffs the United States put on other countries. It was the reciprocal tariffs. Once we did that, they did, just like it's happening today. That's scary. Could we be doing the same thing to repeat the 1929 Great Depression? So yeah, I'm a little bit nervous about that, but I'm not overly nervous. I'm not going to put out I'm not going to take out all my money in the stock market. I got enough cash. I'm happy with that. If you've got enough cash cushion to last you 5 years in the worst, scenario you could think of, you should be all right. And usually it's only 2 years. Most recessions, the Great Recession lasted a few years. And 74, 75, same thing, about a couple of years before it bounced back enough that you had a lot of winners pretty quick on. You had a lot of stocks that didn't do quite as well. It took a little longer to catch up. But for the most part, you're doing pretty well. You recovered pretty well in a few years. And a lot of times recessions don't last that long.
So Tom, coming back to the portfolio thing, I have got two questions. You mentioned you have your cash position is maximum right now, I guess, right? And that what is that cash percentage you hold right now, percentage
Right
wise?
now is 25% of my protected position. And that's pretty significant for me. I've never done that before. What I would normally do would raise my protected position in order to, reduce my cash generate. But I didn't this time because I think that I'm nervous about it. I'm just nervous about the markets in that I think that we are overvalued. Got a lot of bad global news, but I have enough in stocks that I'm good. But I have enough in cash that I'm also good if the worst case scenario happens. Most people are not going to be able to do that until they raise their portfolio's value. That takes time. But that's why, if you're investing, your job is pretty safe. If you buy just a little bit and build that position like that, you will get where you want to be quicker than most people think could happen in the stock market. Most people don't grow their portfolio because when they begin, they take too many risks and they lose too much money. They trade too much, lose too much money, or pay so much in taxes it kind of mitigates any gains that they, possibly have. So I think that's the reason most people don't grow as quickly as they could early on, is they just take too many risks. And if they don't take a lot of risk and they buy a little bit at a time, wherever you try to save a little bit every month from your paycheck, put in there. If you can save a lot from your paycheck, great. You're going to hit your target goals a lot faster than somebody has put less. But somebody that has put less, that's 20 years old, is going to make a lot more money over time than someone 50 years old investing many, many times more, because the compounding is not going to work as well with him as it does for the young fellow that, gets started. So starting early, if you don't start early, you still got to use the same principles when you invest. You've got to, start out slowly.
So, Tom, one a good thing which you kind of mentioned, that your cash cushion, that is based on the protected value of the portfolio, not the actual value of the portfolio.
Right.
Wonderful. So another question, Tom, which I wanted to clarify is that when you are talking about the cash flow yield, is that the free cash flow or that is the operating cash flow you're talking about? Or that is your own version of cash flow, which you used, which you mentioned quite often?
Oh, well, I just use cash from operations minus capital expenditures and come up with a percentage per share. And that's how I get cash flow yield. You divide by the price. So, the cash flow per share by the price gives you a cash flow yield as a percentage. You multiply by 100%.
That is cash flow from operations minus the capex, basically.
Yeah.
And that divided by.
I don't make any adjustments to that because I figure that the P ratio, the earnings, the GAAP earnings will make adjustments. If they're different, something's wrong. I don't make adjustments with with stock-based compensation with cash flow. I use the P ratio to figure out whether there is a balance or unbalance. Something's wrong. Usually is stock-based compensation. That usually takes, if GAAP earnings and cash flow per share is about the same, then things should be pretty good. And you can just use the cash flow yield without adjustments. You do have to adjust P ratios from time to time, especially if there's a one-time event. But just make sure it's not the company's one-time event. They're going to take out stock-based compensation. That's definitely not a one-time event. They're going to take that out. So you can't do that. But if they sold real estate, and this is definitely a one-time event, then you got to take that out. If they're selling real estate every month, every quarter, you can figure that's not really a one-time event either. This is part of their business. So you got to figure out why they're doing that. Most companies don't do that, so you really don't have to worry about that much.
So, Tom, let me ask you this: how many stocks do you have in your portfolio now?
77.
77 stocks.
Yeah, and that's more than I really want.
In general, like, what is a good number? I mean, is there any good number of stocks which one should have in the portfolio where, one is safely diversified, basically?
No, it's like when, if you have one stock and all cash, you're pretty safe. So if you just build up how many stocks you want is how many stocks you can safely, or not safely, but thoroughly study. If you can do that, you can have 1,000 stocks. I don't know how anybody could study 1,000 stocks. I study a lot, but I can't do that. But and I study a lot, but I think if you can study on a quarterly basis each one of your stocks, that's a number you should have or build up to. You don't need it right off the bat, but you need to build up to maybe that. You can build up to that many safely. Now, I've talked to you about this too. If, in theory, if you could study one stock, and that's all you do, study the trading range, everything that you can find about it, mainly the trading range, how the price connects with earnings and cash flow yield with every news event, every macroeconomic event, everything, and become an expert on that. I honestly believe you could take one stock and make all the money you want in an IRA and probably could trade into, to me, if you're wrong on the stock, it's not safe, but you probably could. So what we've talked about before, if you could get 100 people to study one stock, and you can study all they wanted after that, but concentrated on one stock, become many experts on one stock, and share that information. I honestly believe that would be a fantastic way to find opportunities that most people who study many stocks like I do are going to miss. I can pretty much hit the opportunities in my portfolio, but I'll never become a mini expert, a really super expert on every single stock I own. I'm just not going to be able to read that much news. I can pretty much simplify it down to my trading ranges, price ranges. So I've got an idea of how value fluctuates with each one of my stocks, but I can't tell you what news event on every one of my stocks moved it. And being able to value news, I think that's very important. In other words, if there's some kind of news about Apple stock and it moves the stock price, you should make a note of that. And I do try to do that with all my stocks. If it's a major move, you need to put that stock on there because 2 years down the road, that same news is going to resurface. And you're going to know how much it caused the stock to drop percentage-wise that time. So logically, it could do the same this time. So if it bottoms at the same time, that's a logical place to add some money. So that's a really good way to figure out when to add to a stock. You want to compare that also with the valuation changes during that period too. If you do that, if you can do that with every one of your stocks, man, that would be an amazing thing to do, in which case you only maybe need 10 or 15 stocks, as long as they were reasonably diversified. And I'm not big in diversification. In other words, I don't believe in having every industry group accounted for. I was one time very heavily invested in retail stocks only and restaurant stocks. And that's all I needed. I understood them. They were simple businesses. I found out which ones were the best, eliminated those that didn't do as well, shoveled that money into those, and did that. So the ones that a lot of times I would buy stocks, restaurant stocks that just come out at IPO. And I thought, well, maybe we'll try. They've been hyped pretty good. Let's buy a little bit. If it didn't work out over time, I sold them, put them in the ones I did. So I have a lot of restaurant stocks now, and they've done really well. Chipotle has just been an amazing company for me. And a lot of the little companies that didn't do as well, wasn't keeping up, didn't look like they were going to amount to much. I just sold them, put them in Chipotle, Texas Roadhouse. Sadly, no longer Buffalo Wild Wings or Panera, as they were bought. They're no longer public. They also did extremely well for me when I owned them. So I think you can be very under-diversified if you relate that to industry groups, as long as you really understand the companies you're investing in. And retail and restaurants are so simple, so easy to figure out what they're going to do, how they're going to react to news. how far they're going to go down, providing they got, good, strong cash flow and good earnings. They're pretty simple businesses. I would always have some retail and some restaurants. After that, go ahead. Go ahead.
No, I was saying, so you don't diversify just for sake of diversification, basically, right? You pick just great companies based on earning and cash flow, and if it is only from one sector, that so be it, right?
Benjamin Graham, I think, kind of did that too. Same thing. What he would do, he would buy any company that fit his criteria, very strict criteria for a value stock. Mm-hmm. Things you will never find today because those valuations have never been seen before, ever. Well, I won't say it because Tolgray was actually a good one, actually did do that. But that was very rare. But he would buy, even if they were in the same business, same industry, if they were oil based, if it was oil industry or whatever it was, or railroads or whatever it was, that they were sold at what he called well under book value, he would buy them. He didn't care if they were diversified or not, as long as they met that criteria, and that worked for him. Now, I'm not quite that good at figuring out valuations of what they call cigar butt companies. So I tend to use reasonable valuation, which I think is the way Warren Buffett likes to do now. And I guess I adopted that from him, or learned that from him. Was reasonable valuations, they're good. You want them to be reasonable, and if they're not reasonable and they're hyped, you better make sure that market is really a strong market. Because in bull markets, everything goes up, and the best hype stocks go up the fastest, and that's why everybody likes them. Wow, when that market turns, those are the ones that go down the fastest, and a lot of times there's no support. And if you remember the tech bubble, there was a lot of them, even great names like Redback Networks. Everybody hyped that and thought that was such a great company. Went bankrupt. JDSU didn't go bankrupt. They split into little companies, but they were all three little companies were trading in single digits at one point. A lot of them may be gone now too, have been bought by other companies. And there was a whole cemetery of tech bubble, that did well for a while. They're gone. Bankrupt, dead. So you got to be very, very careful about putting too many overhyped stocks. But if you do, make sure it's a good, healthy market.
Sure. So Tom, do you invest like in any other asset class also besides equity?
Other than cash? No, I don't. None. Okay. I've got a trust set up for my wife, and they do bonds, and I don't have nothing to do with that. I won't manage it because I wanted something a little bit safer just in case. I couldn't make them. This trust had to be safe. So they do use bonds, but they also use stocks, and I think it's like 50-50, and that means the growth is not going to be quite as good, but they've done a really good job over time, and I'm very happy with that. I feel it's safe. Something happens to me, she's got that. Then my IRA will run into that, and my other accounts will, I guess you'll break up and spin. But so, I think if you are good with bonds and stuff, yeah, sure, it'd be great. I guess you should. Oh, I take that back. I do own SGov. I don't know if you know what that is. It's a company that invest in United States treasuries, short-term treasuries, and they average about a 4% return. I did put some money into that just as part of the cash cushion. So it's not something I plan on holding there, but it was paying a lot more than Fidelity's, cash cushion. The cash there was making like 2% and still is, where SGov is, and the symbol SGOV is paying about 4%, but when I bought it, it was paying like 5%. So now it's down a little bit, but still better than the cash interest I'm going to get at Fidelity or any other brokerage house. So I think that's okay. But as far as corporate bonds, no, I've never done that. Okay. I'm not saying it's not a good idea. It probably is. I don't know enough about it, and I don't do anything I don't know about. I have to know. I know stocks. That's what time I got. That's what I want to do. And So I stay away completely from corporate bonds.
Okay. Um, I have, I guess two more quick, short questions. I guess, Tom, how much attention do you pay to the these analysts like a Jim Cramer's of the world, basically?
Well, you got to kind of watch them because they're talking to millions of people. So what
Mhm.
they say is going to pop the market, whether they're right or wrong. I
Mhm.
don't put a lot of stock in what they say because they pretty much are going to talk about every stock. And
Mhm.
then with the power of television, go back to the ones that are successful. See, back in 1990, I said, buy this stock. He also said a million others buy this stock in 1990 or 1999 or whenever, date in the past. That didn't do well, but they're not going to go back and say, well, I did this one, it failed, this one failed, this one failed, this didn't do well. They're not going to do that. They'll do it once. Every 30 successes they highlight, maybe they'll do one that they didn't so that they look like they're balanced. But if you look at what they do on CNBC, they pretty much cover every stock in the market. Somebody will talk about every one of them. Well, they're not all going to go up. And some of them don't do well, or they're not going to all beat the market. Most stocks, believe it or not, actually, if they got good cash flow and earnings, they're going to go up. They're going to make you money. They're just not going to necessarily beat the S&P 500. But a lot of them actually do go up. You've got 2 or 3 years, probably are going to go up, providing nothing bad happens to them. Some bad things going to happen to some of them. So I don't really look at them too much, but I listen to them. I see what they're hyping. In case I want a stock on the side that I won't play with, then I do watch them. And every once in a while, they come up with a really good idea. And then I have to go back to the SEC filings to make sure it's a good idea. I do check them. And there's some of the people that I listen to, if they come up with a company on there and I've heard them before and I like the way they invest, then yeah, I'll write that down. I'll go to SEC filings, see if I like it, cash flow, is it good, it's good. And then I'll go ahead and buy a little bit and start my process with them. So I listen to them, but I don't pay a lot of attention to them. Same way with Motley Fool's free articles. They're written by a whole variety of people, and even
Mhm.
their newsletters. They're written by 5 analysts on the average, and they all have different opinions. But I like the way they tend to, if they're a rule maker company, they tend to look at cash flow and earnings the way I do. If they're a rule breaker company, well, I think although they are often have less cash flow and earnings, they do pick stocks I think have the best chance of being one of the better hyped companies. I think they do pick really strong ideals and good businesses that might have good businesses 10 or 15, 20 years down the road. They're not all going to work out right, but their winners tend to really, you know, outpace their losers and make it worth buying a selection of them. But when I was with them and studied those, I just picked the ones that I thought were the best of the best. And I think you do have to do that. And you got to do that with the free articles too. And you can do that again by checking the facts that their pros and their cons with SEC filings. And I do not read just pro articles. I look that stock up, tap it, see who was the bear on it. Seeking Alpha is really good with that because they'll list every one of the stocks you put in there will have bear and bull analysts throughout time, and you can go back years. And when you scribe, and the subscription is not expensive, so it's definitely worth the price. Go back and see what the cons were. That is a good way to learn to value news as it relates to that company. Love doing that. And that works out really well. So I do listen to those sites, Motley Fool, Seeking Alpha, but not to individuals, just to the facts that I can verify. And again, I'm looking for strong fundamentals. If I find one that's really keeps getting repeated, but it don't have good cash flow, good earnings, I might buy a little. If it just a business that made it sound so good, I thought, maybe a little bit. If it's going to be great, then a little bit's all you need. That you're not trying to get rich with that one position. You're going to be able to spread your positions out with all the stocks that you're going to buy over a lifetime. And so that's how I do it. And that's how I listen to them. Stephanie Link, she just come on. I like her. She's on CNBC. Whenever she sticks with fundamentals, and so when she says something, I'm not saying everything she says is going to be right, but that's a good place to get ideals. And I think, yeah, if she likes it, she thinks it's good value, I'm going to check it out. I'm going to go to SEC file and start checking it out. And she's done really, really well, I think. So she's one of the better ones. Oh, yes. When they have all five of the people there, they do, I don't know what they call it on CNBC. The ones that yell the loudest are the ones you don't want to listen to. Listen to the quiet ones. The ones that are getting bullied, they're usually the smartest ones. People have to yell loud to get their point across. They're bullies and probably don't know what they're talking about. That's what I think.
Very interesting, Tom. Tom, I have a last question for you, and that is, how easy or hard do you believe that an individual investor can beat the market or the S&P index, and how easy or hard it has been for you yourself, Tom?
I think beating the S&P 500 is a low bar because all you have to do is beat the average investor. And believe me, most people just don't study enough. All they're doing is watching CNBC. What he said, MicroStrategy, buy. Microsoft, die. Which is good, but if the prices are really high, that could be bad. I'm just looking at the stocks and going across. Carmen Holdings, never heard of that, buy because it's on there. Can't do that. I mean, you gotta study. So yeah, if you want to study your stocks, like I say, you start with the first one, and it starts beating the S&P 500 using your criteria, your set of criteria for that stock, and it worked. Try to emulate that. You get one that fails, it's not doing good. It's not beating the S&P 500. Maybe it's even losing money. Well, then you got to figure out what caused that to lose money. If they got good cash flow and good earnings and they're losing money, then you haven't held it long enough. Most likely it's going to go up. Now, 3 or 4 years down the road, if it's not beating the S&P 500, you got to figure out why. Usually it's because of valuation, maybe. Could be something else. But that's when you want to make sure you're maybe not thinking about adding to that stock. So I add the stocks that are actually having good performance based on the S&P 500. That's why I don't think it's that difficult. Well, if you're knowledgeable about your stocks, it's not that difficult. If you're a beginner, it's difficult because you're going to have to study a whole lot of stocks. So if you got 100 friends that help you, that's great. You got 10 friends that help you, that's great. Got 5 friends that help you, that's great. Got even one more, that's better than nothing. You got one friend, that's good. You got some help, some back and forth, and I think that's important. And with the Motley Fool and the message board, you've got a lot of people helping each other. That's the part I do miss about it. You get a lot of help from the message boards, and I like that. But it was taking a lot of time, and that's something I couldn't afford to do. I mean, I'm good with helping you and helping certain friends, stuff like that. That like to study the market. I like that. I think that's good, and it helps me too.
And Tom, you have not only helped us, you have taught us how to invest well. I have not learned, from anywhere else. I mean, I just learned all of my investing just by reading your posts, actually. And you have been a tremendous teacher and a guide and a mentor to all of us, everyone who was involved with the Motley Fool discussion board at that time.
Well, I appreciate that. I did want to add one more thing. It's easier to beat the S&P 500 if you have a long-term perspective. And over time, beating it any 1 year,
it's luck, right?
That just depends on the economy. If we're in a bull market and you got the best stocks, ain't no doubt about it, you're going to beat the S&P 500. The trick is also having to beat it when the market starts turning. You still want the best company. So, yeah, I'm going to say it hasn't been that difficult. I think I've done a really good job over time, and it didn't seem that difficult. But I had the Motley Fool to help me. That really helped because I learned about all these stocks that I probably would have never studied. And you still do that because they're still, you get the free articles for free that even if you don't want to subscribe. So I don't work for the Motley Fool anymore, so I'm advertising for them. But I think they're really a good site. And again, Seeking Alpha, that's another one. I really believe you can. It's a good site. They're going to have a lot of stuff maybe want to toss. They write a bunch of articles, but find the stocks that you like, put them in. If you do that, you buy better value points, and you do that. I think it's That's the part that's key to beating the S&P 500, is not being afraid to buy if the price goes down. And if you do that and the value's going up, if the price going down, the earnings are going down faster, well, that may not be. You have to think about that. But if it's a good stock and it's just because we're going into a recession, still you need to do that. If that's one of your better stocks and it's done good, pre-recession, chances are it's going to do good in recovery, especially if they've done, still have good cash flow and earnings, or just cash flow, have some cash flow and earnings during a recession. Evidently, obviously, cash flow and earnings are going to drop during a recession. But if it's still a reasonable amount, they're not going negative, you still buy some. And if they've done well before the recession, even if they go negative, you can buy some. You can think about that one anyway. You can put it on your list. If you do that, and even during these cycles, if you buy better value points, I'm going to tell you, I see the whole point of the better value points is you got a gap. The S&P 500 is pretty steady. You're buying under, your stock's going down. You got that gap when it recovers, even if it just recovers to the point here, you're going to beat the S&P 500. That's why I think it's so simple. As long as you can study your stock, but you do have to study a pretty good range of companies or be very confident in the few that you own to do that. So I guess there's a level of difficulty. You own enough stocks, you've done it for enough time, it does seem pretty easy. Mm-hmm. But for somebody starting out, maybe it's not that easy. And then you really do have to learn. It's a learning process, a learning curve. But if you learn how to do that value point thing, and you don't worry about buying when the price is down. Just don't load up on any one stock when the price is down. Buy a little bit, look for another one. Is this value point better than this as they relate company-wise to, history, how much earnings they actually make, how much cash flow they actually make. If the P ratio on one and everything's pretty much equal afterward, then buy the one that's, P ratio is better and maybe the gap's a little bit high, a little bit deeper. So things like that, I think it makes it a lot easier. And I think if you do that, then it becomes, let's say it becomes a lot easier, I think, to beat the S&P 500. Hey, believe me, over time, to me, it's very easy because you're only having to beat the average investor. You just have to outsmart the average investor. That's it. And most of the average investor, I'm pretty much, they don't study much. So I don't think it's that difficult. And as we get more into passive investing with market mutual funds, they have a lot of rules. They're way too diversified. So all you got to do is pick the better stocks among the mutual fund picks. And that's easy to do. Find them on CBNC. And the one they talk about the most, make sure they got cash flow and earnings. Usually, that's all you need to beat it. And I think that's all you have to do. I think anybody can do it. I think it's something you can duplicate. My opinion, that's what I believe.
Tom, it has been just great to hear you. And I love the whole interaction. I'm sure we are going to come back again to do a part 2 of this to learn more about the different value points you're talking about, or the portfolio, the protected value to manage your cash cushion and things like that. But I just want to say thank you so much, Tom, for graciously agreeing and giving me, so much time and teaching us all about, your journey and how to do the stock valuation and portfolio management.
Well, I appreciate it. Thank you for having me. I had a good time. I enjoyed it. I was looking up my screen battery, just about running out. So we ended at the right time.
Yes. And I'm sure, we are going to do a part 2 again, in due course of time. Yeah, Tom, thank you so much. And you have a great weekend.
You too.
Thanks. Bye.